Most people fear market crashes. When the stock market takes a dive, they panic, sell off their investments, and lose money. But here's the shocking truth. The rich actually make more money during crashes than they do in stable markets. Did you know that during the 2008 financial crisis, Warren Buffett made billions by buying stocks at their lowest points? Or that, in the same year, the wealthiest 1% of Americans increased their net worth by over $2 trillion while the average investor lost money? This isn't luck, it's strategy. The wealthy understand something most people don't. Market crashes aren't a time to run away, they're a time to run towards opportunity. In this video, we'll reveal how the rich profit when the market crashes, how they stay calm when everyone else is losing their minds, and how you can do the same. Stick with us, because we're about to unlock the secrets of the wealthiest investors and show you how to use a market crash as a tool to build wealth. Chapter 1. The Crash-Proof Secret. Why the wealthy don't panic when the market crashes, the rich don't flinch. They don't panic, sell, or make rash decisions. Instead, they stay calm and stick to their strategy. The key to this calmness? Emotional control. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." In times of market chaos, the wealthy think long-term. They know that downturns are temporary, and smart investing requires patience. The ability to stay calm is learned, not inherited. Studies show that investors with emotional discipline outperform others over time. In fact, research by Dalbar found that the average investor underperforms the market by about 4% annually due to emotional decisions. When everyone else is selling out of fear, the wealthy see it as a chance to buy. For the rich, a market crash isn't a problem, it's an opportunity to buy quality stocks at discounted prices. It's also why they tend to keep a level head. A calm mind allows them to make better decisions. History shows us this pattern. During the 2008 crash, the wealthiest investors, like Buffett and Soros, made huge returns by buying assets at rock-bottom prices. Chapter 2. Bottom fishing. The art of picking stocks when everyone's running. Buy when there's blood in the streets, said Baron Rothschild, a saying that has guided savvy investors for centuries. During market crashes, stock prices plunge, often indiscriminately, and that's when the wealthy go fishing. But they're not just looking for any fish, they're looking for the big, undervalued ones that will rise again once the storm passes. It's a strategy called bottom fishing. It's about finding strong companies whose stock prices have dropped more than they should have, and then buying them at a discount. Take Apple, for instance. In 2008, when the market was in freefall, Apple's stock fell over 50%. Those who saw value and bought and saw their investments grow exponentially in the years that followed. The wealthy know that a company's value doesn't disappear just because the market crashes. They dig deeper, focusing on businesses with strong fundamentals, low debt, good management, and a track record of resilience. Research backs this up. According to a study by Morningstar, stocks with solid fundamentals that are bought during market corrections tend to outperform the broader market over the next 5 years. The key here is to focus on the company, not the market's panic. When you buy quality, you're setting yourself up for success, even if the market takes years to recover. For everyday investors, the concept might seem risky. But the wealthy understand this. Buying stocks at depressed prices is a long-term strategy. As the market recovers, so do the values of the companies they invested in. The rich are patient, and they are willing to wait for their investments to pay off. Chapter 3. Cash is king. How the rich build their war chest. The wealthiest investors always have cash on hand. It's not about hoarding wealth, it's about being ready for opportunities. During a market crash, having cash allows them to make strategic investments while others are scrambling. Think of it as building a war chest. This war chest can be used to buy stocks, bonds, real estate, or even entire businesses when the market is in turmoil. Take the 2008 financial crisis as an example. When Lehman Brothers collapsed, the stock market lost nearly 50% of its value. But those with cash were able to purchase distressed assets at bargain prices. Warren Buffett himself made $5 billion from his investment in Goldman Sachs during this time. He had cash and knew exactly when to strike. He's often said, the most important thing to do if you find yourself in a hole is to stop digging. According to a report by the Federal Reserve, the wealthiest 10% of Americans hold 70% of the nation's wealth. A big reason for this is their ability to save and invest in downturns. They don't rely on credit, they build liquid assets that can be deployed quickly when markets are down. During the 2020 crash, for example, billionaires like Elon Musk and Jeff Bezos saw their fortunes grow by billions, thanks to their ability to invest at the right time. Having cash also means the rich can avoid selling during market crashes. Unlike many regular investors, who might need to liquidate their holdings to cover losses or living expenses, the wealthy don't have this pressure. They can hold their assets until the market recovers and come out ahead. But how do they accumulate cash? It's about being disciplined during the good times. The rich know that the market cycles, so they prepare for the down cycles. They save, invest wisely, and keep a portion of their portfolio in cash or liquid assets. This strategy enables them to take advantage of market downturns, while most others are stuck selling off investments at a loss. Don't forget to subscribe to the channel for more investment strategies that can help you think like the wealthy. Hit the notification bell so you never miss an update. Chapter 4. The Power of Patience. Why slow and steady beats the herd mentality. The rich don't race to make a quick buck. They understand that wealth building is a slow process. In fact, some of the most successful investors in history, like Buffett and Charlie Munger, are known for their patience. They don't try to time the market, and they certainly don't let short-term fluctuations affect their long-term strategy. During crashes, the majority of investors panic and sell their stocks at a loss. But the wealthy know that the market will eventually bounce back. It always does. This patience and long-term perspective give them a major edge over those who only care about the next few months or even days. In times of panic, the wealthy simply stay the course. As Peter Lynch, the famous fund manager, said, "The real key to making money in stocks is not to get scared out of them." By sticking with their investments through tough times, the rich avoid losing money and often see their wealth grow exponentially once the market recovers. Chapter 5. Diversity over panic. Why the rich don't bet at all. The wealthy don't put all their eggs in one basket, especially during market downturns. Instead, they diversify their portfolios across different asset classes, stocks, bonds, real estate, commodities, and even private equity. This diversification acts as a safety net when the market crashes. When one investment falls, others may rise or stay stable. A diversified portfolio ensures that the rich aren't too exposed to any single investment. If one sector is hit hard, like tech in 2000 or real estate in 2008, the rest of their portfolio can help offset the losses. During the 2008 crash, while housing values plummeted, the stock market presented other opportunities. The wealthy knew how to adjust, shifting focus from one asset class to another to protect their wealth. Studies have shown that diversification reduces risk and increases the likelihood of steady returns over time. According to a report by Vanguard, a diversified portfolio has historically outperformed a concentrated portfolio, especially during market downturns. This approach gives the wealthy peace of mind. They know their wealth is protected, even in times of crisis. Chapter 6. The Wealth Builder's Blueprint. Why market crashes are your stealth opportunity. Here's the final secret. Market crashes aren't just something to survive. They're something to thrive in. The wealthy understand that every crash is a wealth-building opportunity. It's the perfect time to buy undervalued stocks, acquire real estate at a discount, or invest in businesses that are temporarily struggling but have huge long-term potential. By focusing on fundamentals, keeping a cool head, and sticking to a long-term plan, anyone can make money during a market crash. It's not about predicting the market, it's about positioning yourself to take advantage when it hits rock bottom. As we've seen in history, the rich come out on top after every crash because they follow these principles. If you start applying them today, you'll set yourself up for success, no matter what the market throws at you. If you enjoyed this video, don't forget to like, subscribe, and click the notification bell to get more wealth building tips straight to your feed. Here's to your financial success.